You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It is the 29th of April 2023, and I am rejoined by Joe Value, who is at Joe Value on Twitter, for part two of his interview, where we're going to be talking about his actual portfolio, how he runs it, and some of the stocks in it. So, Joe, thank you very much for coming back on the show, although we are recording this in one big session. So thank you very much for your time.
Yeah, thanks for having me. Yeah, it's great. Been enjoying the first half.
I'll just jump straight in. For anyone who's not listened to the first half of the interview, I would strongly recommend it. If you don't want to, that's fine. If you get to the end and enjoy this, I would recommend going back and doing the first one. But if you want to just do this one, that's up to you. So just picking up where we left off, what are your thoughts on current valuations in the US?
I think they're quite widespread. I think you've got pockets of overvaluation, pockets of undervaluation. I think the spread is quite large at the moment, but yeah, and there's a lot of uncertainty in the market, so I think that's probably the reason why.
In what you're doing, do you notice a difference between the valuations you're looking at and, say, the S&P 500, for example?
Yeah, there's a big difference, yeah. And I think there always should be, because, you know, the smaller companies have got, you know, less liquidity, they're less followed, and smaller companies are less stable in general than much larger companies where change happens much slower. And I think, you know, if you do want much bigger returns, the volatility helps in a smaller company, because, you know, you haven't got a chance of Apple like doubling or tripling in a short space of time, but you do have a chance of a smaller company doubling or tripling, just because of it could be absolutely hated and things going wrong, and then as soon as something gets better and people realize it's actually not that bad, it could, you know, triple in valuation quite easily. So I guess that's the reason.
So I appreciate this is probably quite a difficult question to answer, just because every company is different. But say for the S&P 500, where like a typical PE ratio is probably 20 plus, I don't look at US small cap at all. Firstly, what are you defining as small cap? And then what would the actual typical PE ratio that you'd see? So like if the S&P's say 20, would you expect to see 10, just as an example?
Yeah, so small cap is, I'm kind of saying anything, you know, around, I guess, less than 500 million and more than 50 million. So it's quite a big range, I guess. And then you got the micro caps and nano caps, which I do actually look at as well. I haven't really invested in anything below 20 million. 10 million is probably the lowest I've gone. And the P ratios, or kind of the EV/EBIT ratios, are EV/EBIT, like I'm looking at kind of maybe 2 to 4 times, or that kind of range sometimes. And P ratios are more like, you know, definitely less than 10 for a lot of things. But not always. Some of them are, you know, very high quality businesses that there's just something going on and the PE ratio is quite high. I mean, PE ratio is a good indicator, but it doesn't really tell you everything you need to know about valuation, really.
Would you plan when you would get out of an investment in advance? And is there a size at which you would just say, well, if an investment gets to this size, that's fantastic, but I don't want anything above this size? Or would you, in theory, be happy to just ride it as big as it got, as long as you carried on liking the business?
Well, it's a very good question. I think the great thing about special situations is that often the time frame is determined for you. And I think one of the hardest parts about investing is actually when to sell. It's very easy to kind of sell things too early when something's going great and kick yourself later that you didn't hang on to it, or, you know, you've sold it completely and didn't scale out of it and whatever. Generally, a lot of the kind of special situations that we see, it has a definite time frame. So it's when this event happens, then I'll sell, or then you're forced to sell. You know, like, for example, if you've bought something that is going to be bought out, you know, that time frame is there. That's it. Your shares are bought. You know, the Garrett motion has been one that I probably should have, once the catalyst happened and once they re-emerged from bankruptcy, I probably should have sold it fairly shortly after that, because that was my catalyst. But then because of the complicated share structure. And actually, I thought that the business was so materially undervalued when it re-emerged from bankruptcy that I just kept hold of it, and I've had that since it re-emerged. So that was kind of helped by the fact that the preference shares that I bought were yielding 11% as well. So it was kind of being paid while I was waiting. So it really depends on the kind of investment. And there are a couple of things I would just be happy to hold until it plays out. Some of them don't have a fixed time frame, but I kind of most of them do.
So, seeing as you brought it up, so you've already touched on Garrett Motion in your previous interview. So I'm just going to assume that people have heard that. So you mentioned that it was basically it was going into bankruptcy, but it was a voluntary liquidation, and all the big funds had to get out at that point. So you just had a lot of forced selling as a result. Could you just talk about why you actually liked the business and what it actually did, and why you did, and why you did want to carry on holding after, like you say, that event had happened?
Yeah. Okay. So it was a voluntary Chapter 11, so bankruptcy. Okay, so basically, they make turbochargers for cars and small vehicles, and there is they operate a duopoly. So there's Borg Warner and Garrett Motion, and they have together, I think they have about 90% market share, and they're split quite equally between the two. So it's got an extremely strong moat, because you've seen over the past years other competitors trying to enter and increase their market share, and they just haven't been able to. And it's it's a very specialist kind of company. They have a great stickiness in their product, and very easy to project their revenue, because when a car company decides to make a car, they have to include the turbocharger as part of their design. So they'll be looking 3 to 4 years ahead of producing the car. They'll sign up Garrett and they'll say, this is you need to provide the turbocharger, and then they have that contract up front. So it's not that they're not going to abandon that because they're developing the car, So they've got very good look forward, and and it's got a long history. It's a well-run company. I mean, so the reason why they had trouble was that it was a spin-off, and that the parent company offloaded a whole load of completely unrelated asbestos liabilities, which Garrett had nothing to do with, and it was unfairly given to them. And so the reason why I'm happy to hold it continuing is because it's actually a very strong company. It's got great fundamentals, and it's a high quality business. It just had a bad capital structure, but now that's kind of been resolved. So, and also it's run well at the moment, because the hedge funds that actually brought it out of bankruptcy were Oaktree Capital and Centerbridge, which top of the game. They know how to allocate money, capital for sure. And so all their capital decisions since they've come out of bankruptcy have been spot on, which is not a surprise. So as long as it's being managed well and it's a high quality company, and I guess the other thing that's keeping the valuation low is that people say it's a melting ice cube, because eventually they won't be able to, or the internal combustion engines will die out, and then we'll just be left with electric. And obviously turbochargers only work with combustion engines. But I think that argument is falling away now, as people see that it's just not going to happen within the next 10 years. It's going to be a lot longer than that. And if you allow for the fact that, within the next 10 years, it will earn its market cap twice over, it's an extremely well covered business, as long as they don't make stupid capital allocation decisions, which they haven't done.
What's the valuation like at the minute? And why is it? Is this this is a US listed one if it's Chapter 11?
Yeah, US listed, and it's headquartered in Switzerland. Valuation, I think, my kind of target price range is trading at 8.5. Target price range is between 10 and 15. I keep quite a broad range, but above 10, 12, something like that is potentially where I might look at scaling down, because it's a very large position for me.
So what would 15 be? Would 15 be exit fully, or would it just be you need to take a look at this?
Yeah, I mean, it would probably be exit fully, but it depends on, why has it gone to 15? Is that because they've done something amazing and therefore it should be more like 20? I don't know. Yeah, you have to reevaluate it before you sell it, obviously. But if everything stayed the same and tomorrow it was 15, I'd probably sell it.
What do you think of current valuations in the UK and when compared to the US?
I think there are quite a lot of undervaluation in the UK, especially as smaller companies. I think in general, companies in the UK are actually run worse than the US, and I think there's poorer capital allocation decisions, and there's more self-interested management. I guess they're less aligned to shareholder interests, and I think that might be part of what's causing the valuation difference. That's quite a sweeping statement because obviously there are a lot of very well run companies in the UK. But I suppose when you get into the smaller companies as well, I think there's a lot of not full alignment with the shareholder base, and just there's probably less people looking. So I also, obviously there's the whole Brexit and uncertainty around that, and what that effect is on the economy, and we've got much higher inflation as well. So yeah, I think there's a lot of factors. I try and keep up to date with the macro event and like outlook, but I also try and not let it influence my decisions too much because I think I end up chasing my tail and thinking, oh, this and this and this, and then going back to square one and going, I'm not really sure how that helps me. But
What do you think then, for example, the bigger caps? So if you were to compare, say, the FTSE 350 to the S&P 500, what do you think of the valuations there? Or if you don't look at it, that's fine.
I don't actually look at it, but I think one of the important points about comparing the S&P 500 to some of the UK companies is that often the UK companies are quite domestic focused. Obviously, you do have some global companies, but a lot of them are serving like regional markets, and they're actually just much smaller in size. Whereas with the S&P 500, you're actually looking at mostly global companies. Obviously, there are domestic ones too, and I think that makes a difference in terms of who your customers are and the level of diversification that you have. So I think they're quite sometimes quite different beasts.
How do you feel about allocation and position sizing?
So this is something that I'm working on right now, which is probably my biggest thing that I'm working on. And I think the tendency before was to concentrate too much. And it's one of those things where, people say, oh, you should diversify and you should not concentrate too much and whatever. And I think it's one of the things that potentially is, well, for me, has been difficult to learn just from books, and just I've got to realize that through experience. And the main lesson that I've taken away is that once I concentrate too much, then it actually affects the way that I think about the investment. And if something bad happens, then I give it more of a benefit of the doubt just because I'm so heavily invested. And I know that's the wrong thing to do. It's just a psychological bias that's very, very difficult to get rid of. But when I think over concentration, however much that is for you, actually, brings with it a lot of psychological and emotional biases that are not, that are obviously bad for investing. So I'm looking at much more diversification, probably still very concentrated compared to a lot of investors, but looking between 10 and 15 positions rather than sort of more 5. And I think that will just help me maintain kind of more rigor and logical thought. And yeah, so that's something that I'm looking at more.
So when you say 10 or 15 positions, would they all be equally weighted, or what would be sort of what would be a small position for you and what would be a big one where you're thinking, bloody hell, I'm not comfortable holding that?
Yeah, so I think in the past I've gone up to, even like 30% at cost, which is just too high. And now I'm kind of saying, look, my new limit is really 10%, so I don't really want to go over 10%, and that's at cost. So I've yet to think about whether I'd scale out if it did increase a lot from the 10%. But I think the at cost basis is probably the most important one for me, because just from psychological reasons, I guess. But yeah, for example, 15 positions, you could have a couple of 10% in there, and then some smaller ones. But I think 10% would be my max from now on.
I actually look at mine on the cost basis as well. I know
Yeah.
at some point if it goes up enough, it's a nice problem to have, but if it goes up enough, I might get uncomfortable on a valuation basis. But I tend to just leave it based on valuation. If I'm quite happy with what I put in on a cost basis, I'll just stop adding to it. I mean, this is probably going to be quite high because you're a fund manager. But how much time do you spend a month on investing in your portfolio?
I don't actually track it, but I just spend all my free time on it and all the working time that I've allocated to it. So it's a lot. And, I probably don't stop thinking about it enough, but I don't have a number, but it's pretty much full time apart from the bits I've got to do with some of the actuarial work that I'm doing.
So just all the time you've got, basically.
Yeah. I mean, obviously I do wind down and, I have family and, a 3-year-old and stuff. And when I'm doing that, I'm obviously not thinking about it and just having fun with the family. But yeah, pretty much all the time.
What are your thoughts on Bitcoin as an investment?
It's such an emotive, like divisive kind of topic. Like I don't really have very strong views. What I guess the parts that I have strong views on are that I really don't like all the scammers and the people that are, think it's awful. The people that have been misled by some big names that are very highly influential. I just think that's really really gross. People losing their life savings and stuff. I just feel really bad about that. I don't really understand Bitcoin. I've spent a lot of hours trying to figure out what Bitcoin does and where the value actually is. I can't figure it out for myself. So it's just either I've missed something completely, or it's some kind of like tulip mania type thing. Yeah, I guess that's where I am with it.
Have you read Digital Gold?
No.
It's Digital Gold by Nathaniel Popper. If you are wanting to read a bit more about it, I'd probably recommend that one. So it's very interesting. So it's basically like a biography for like the start of Bitcoin. It's not really sort of like it's basically just a history of how it came about and the early history of it. But it is just a very interesting book. It's not really an investment book, but it is very interesting. Do you view Bitcoin any differently to how you perceive any other cryptocurrencies, or do you just lump them all in together?
Yeah, I probably see it a bit differently, as in like it's quite a good indicator as to what's going on in the whole cryptocurrency space, and it's the leading one that everyone looks to. It's quite a good gauge for those kind of market trends and forces. But other than that, like, I don't understand it, so it's something I'm just staying away from. And I don't need to understand everything. I just need to understand the stuff that I do. And I think that approach is like quite key for me, is that it's focusing on what you do know and just keeping within your core competencies. And like it's very tempting, and you've got that fear of missing out when you're looking at all sorts of opportunities and going, wow, that could be the next big thing and this and that. And it's actually, yeah, that could be, but I don't need to be greedy and try and go for absolutely everything. I'll just stick with what I know, and then I know that I can do well from that. So that's kind of something that I've been really picking up from with I've got like an investing mentor, and he is so focused on exactly what he does, and I think it's just brilliant because it gets rid of all that noise and all that thought about worrying about something else or trying to figure out something, and you can just literally spend all your time focusing on what you're really good at and what you have an edge on. So I really admire that, and I think that's something that I'm continuing to work on myself.
How did you end up getting an investment mentor?
Through Twitter, yeah. So just
right.
conversations with people, and then just through Twitter. I had regular video calls and just calls with him and stuff. So it's a great guy.
What do you think about? I appreciate it's not something you'd ever do in your fund because it's just not what the fund's for. But what do you think of commodities as an investment, or is that pretty similar comments?
No, actually, like I have been looking at commodities, and I had a small position in some coal companies just because I thought they were. It was kind of a special situation in a way. It was just like they were so extremely undervalued because of the ESG drive and just undervaluation in mines, and then the kind of energy crisis and stuff. So I did actually have a small position in that, and I've also invested in another miner which was incredibly cheap coming out of COVID, and they've all done quite well. But I haven't felt like 100% comfortable with them because I feel like there's such specialists that are looking at those individual stocks that have huge that they're actually in that industry and they have huge experience and understanding as to how the actual business runs and what can affect the business. And I often feel like I don't know what I don't know, and that kind of scares me. It's not just a simple business because there's so many elements to getting the commodities out of the earth and transporting them and what to look for, and yeah, some of it's quite counterintuitive as well.
Have you ever looked beyond the actual companies that are sort of like mining or producing the commodities? Have you ever looked at sort of like a wider commodities index or anything like that, or just a pure play on the commodity itself?
Yeah, I mean that was one of the big wins that I had coming out of COVID was just oil, or just I think it was USO or something, one of those kind of indexes where it just tracks the price of oil. And I just thought, when oil is trading at below the cost of production, there's got to be something seriously wrong with that price, because oil demand's not going to go away overnight. It's just a temporary thing. So a temporary price distortion. So that was something that I did. I really like those kind of things because it's such a simple kind of argument, really.
Would you be allowed, so using oil as an example, would you have been allowed to buy that in the fund on the basis that if it's below the cost of production, you'd regard that as a special situation, or is that just, it's not what it's for?
Yeah, no, it's quite a broad definition, I guess, that I have a special situation, or it's like a special situation focused fund. So it's like, I guess, event driven, capitalist driven type thing. It's not like I'm buying it because it's really cheap and at some point it will revalue, or at some point it will, come to the mean or whatever. I can't really justify those kind of purchases, but I can justify something that's, a current event that's going on that's, going to be temporary, even if I don't know exactly how long it will take. It's event driven, I guess.
Okay. So going back into your individual portfolio, you've got Pershing Square Holdings. So why do you like this? And why do you like it so much that you're quite happy to pay fees of 2.66% a year for them to look after your money?
Yeah, so that's a good question. And the thing is that this is probably the least representative of my portfolio. And I almost see it as a semi quasi cash holding, as in like it's super liquid, obviously, 'cause it's huge. And it's like I park some of the cash there when I'm looking for other opportunities. And the reason why I do that is because, firstly, I think it's quite a good diversifier because it's invested in very high quality businesses, and it's a fund that Bill Ackman's fund that owns a few quite concentrated, very high quality businesses. He knows what he's doing, in my opinion. He has made mistakes in the past for sure, but his own money is tied up in there. So I think that he knows what he's doing. I also think, he's made some incredible decisions during times of uncertainty, especially in COVID, where he's made some huge, huge wins. I think he turned 125 million into like 1.25 billion, something like that. I can't remember the exact figures, but it is massive. And so I kind of park cash there. But the real reason why I park cash there is because it's trading at a discount to NAV of over 30%. So you're buying extremely high quality companies with a discount at 30%, which is very, very big. And not only that, but obviously that discount to NAV is a kind of personal insult to Bill Ackman, and he takes it that way anyway. I think he's very unhappy with that. And so he wants to do something about it. And, he's a smart guy. I'm sure he'll figure out a way. I think there are at the moment, it looks like his main thought on fixing or getting rid of the discount now is to create a kind of Berkshire Hathaway type vehicle using Howard Hughes, which is a REIT, like a property company. And so he's building up a position. He's continuing to buy that. Once he gets to a certain size, then he can use that vehicle to buy the Pershing Square holdings and then get rid of the discount to NAV that way. And so, I've kind of parked cash there with what I view as quite capable hands in high quality businesses that are quite diversified to the rest of my portfolio, and with an upside of the extra 30% when he gets rid of that discount to NAV. So kind of a special situation there, but it's maybe pushing the definitions, but I'm quite happy with that anyway because I like to have a bit of liquidity on the side and don't necessarily want to put it into like treasuries or gold or something like that.
So when you're talking about this discounts to NAV, so these are all large public companies. So does that mean if you had if you were to go and basically recreate that portfolio yourself, it would cost you the extra 30% because that's the difference between the P of what it's trading at and effectively of what you're getting it for when you buy it through Pershing Square?
Yeah, that's basically it. So
that's very odd for companies that size, isn't it?
It is, yeah. It's to do with the structure as well. That it's in a trust, so often trusts. So it's an open-ended trust, but and they often do trade at some discount, but not 30%. You get 10, 15, 10, 5, 10% or whatever at times, but it's traded consistently above 30% for a while now. So yeah, it's large enough to kind of take note and go, hang on a sec, there's something going on here.
So why do you like Hurricane Energy? Could you just explain briefly what it is for the people who've never heard of it?
Yeah, so Hurricane Energy is a UK oil producer, quite small, it's not massive, and they had activist investors that basically forced them to seek a sale of the business. They weren't managing it well, and they had an unsolicited bid in November time or something, and they rejected it. And then since then they've led a tender process, and they've had I think 5 potential offers, and they've gone with one offer. And the offer that they've gone with that they announced was to buy the shares for a certain amount of cash, and then a DCU, which is like a profit share kind of unit that they'll give to shareholders, and they'll give up to I don't have all the figures in front of me. I think the shares were trading at like six and a half, not dollars, but I think they're 6.5 pence, and they were basically going to get up to 12 pence per share from the acquisition. So it's a big upside. But what was amazing was the downside coverage, which was that they were going to give back. So you buy $6.5 pence a share. I think they were going to give back like 5 pence per share initially, like upfront as soon as the deal closed, or like 2 weeks after the deal closed, and then another kind of distribution, which almost equated to another whole pence. So then you're getting almost all your money back by the end of the year, and then this profit share unit that they're giving will run for the next 4 years and will take 25%, 15 or 25%, I can't remember, of the profits from this oil field that they sold, and that will generate up to another, I think 8 pence per share, up to 8 pence per share in total. So basically, what I'm saying is that you can get the majority of your capital that you invested at the time back within the next 6 months, like fully in cash. There's no risk once you've got the money back, obviously. And then you've got all the upside of the profit share of the oil field going forward for the next 4 years.
So what's the risk now?
So I don't know whether the share price is trading. I think the share price is trading at like 7.5 pence per share. So the downside has gone up because you're not going to get as much of your percentage-wise of your initial cash invested back. I don't really know what the risk reward is there, but I haven't looked at that. But it's less good because the upside's less and the downside's more than obviously than when I posted the idea and also when I invested in it originally.
But is there any likelihood of this deal not going ahead still?
There's very little chance because they need a certain amount of votes, a proportion of votes voting for it, and all the big investors are on board, and also they've held a beauty pageant or whatever you want to call it to get these offers. So they've actively sought out these offers. This is the one that they've actually chosen. So I think it's almost guaranteed, and I think in July the decision is made, or June. Yeah. So once a decision is made, then 2 weeks after that, you get most of your cash back, and wait another 6 months for they redistribute the profit share cash every half year.
So what's a Tento, and why do you like that one?
So that's probably been my most difficult investment so far. So going into, it was at least a year ago now, maybe nearly 2 years ago actually. Yeah, 2 years ago, it looked like a turnaround with that they wanted to sell the business. So so it's quite an easy special situation. They had Goldman Sachs looking for buyers on behalf of them. So they wanted to sell the business. The reason why they wanted to sell the business was because the majority shareholders ended up having the shares. They never intended to own the equity. They actually lent the company money and then had the shares as collateral for the loan they gave, and they ended up being given the collateral instead of the money back. So they never wanted to be in that business. So that's why they wanted to exit. They're just PE funds basically. And that was all going to be fine. And, the turnaround was clearly working. It looked good. It looked like the sale was going to happen in the next 6 months. And then they had a cyber attack. And that was the first big blow. And that was, looking back on mistakes, like I should have just sold at that point, because, there was quite an uncertainty as to how impactful this cyber attack would be. Ended up being quite impactful, like cash cost of like 90 million, I think. Considering that the market cap was like 400 million, that was pretty big. Then the next big blow was the size of that. They made a really bad currency hedge, which actually wasn't a currency hedge. They were trying to hedge their US dollar liabilities with the real, because they're based in Brazil, and they weren't actually able to get a full on currency hedge, so they decided to do an interest rate hedge, which was the worst thing that they could do. They hedged their interest rate, the Brazilian interest rate, at 2% was their strike, and it went up to 13.5% or 13.75%. So it absolutely cost them an absolute fortune. I think it cost them in the region of 150 million in cash costs. So it's incredibly bad capital allocation decision. And they're also quite levered as well. They've got, 500 million of debt. So lots of bad things happened to it. Then CEO left, got rid of by the board. So we've got a new CEO, new CFO. So you've got none of the people that made the bad decisions now in charge of the company. You've got an activist investor who's now on the board, and there's a new chairman of the board as well, who's ran a previous company, which is a BPO company, like a outsourcer, call center. Yeah, that's the business that they run. So this guy that's the chairman of the board, he's great, and he's basically cut a whole load of costs in the last year or 8 months or something. So he's really helping with the turnaround, and he was CEO of a business that was sold as well. So I think the board is much, much more capable than it was before, and then the management is more capable as well. But because of the level of debt and the very high cash costs that they've had, it's almost struggled as a going concern. Though there's been concerns that like its debt was trading at 30 cents on the dollar at low points. So it was really the market was really worried about bankruptcy. Since then, they've had a new raise. They've raised more debt to shore up their cash position, and basically now waiting for the hedging costs that they've had. They've been cash costs, and they've been paying them out, but the hedge costs will come down after August. They'll reduce quite significantly and then eventually fall off. So it's not going to be like a permanent cash cost. And that will really help with the cash flow of the business. And in the meantime, the actual business itself has been fine, super stable revenues and top line, and margins have been increasing as they've been cutting costs, obviously. So the actual the actual business has been fine, but the capital structure and the costs associated with that have been way, way too high. But once it normalizes, if basically they're able to stabilize the business and then show that they don't have a liquidity issue, then the market should revalue them as a going concern. But at the moment, they are priced with a lot of risk of going bankrupt. And so that makes them incredibly cheap. It's also incredibly illiquid, very difficult to build a position size in that. There'll be like 1,000 shares traded a day, and it's been traded at around the $2 mark. So it's really, really illiquid at the moment. But when news comes out, often the liquidity increases, and you can get like 500K's worth or a million's worth in a day. But yeah, depends on what's going on.
This is the final question now. You hold Polar Capital Global as well, which is another fund. Is there a reason? Well, firstly, why do you like this particular fund? But is there a reason that you're holding? I know you might have covered it already in your answer with Pershing, where you almost view it as like instead of cash. But is there a reason that you're holding these over having like a proportion of your portfolio in index funds instead?
So this was more a kind of response to Polar Capital. I can't remember what the end of the thing is, but basically it's a bank and insurance fund. And the reason why I bought it was because of, the big banking panic that we just had recently, really depressing a lot of the prices, and that the ETF dropped, but it holds very high quality banks and insurance companies that are largely unaffected, or so far largely unaffected anyway. I just thought it was quite a nice contrarian bet, just spread that risk on the kind of sector that's impacted. Obviously when big things like that happen, people get emotional, and then the psychological impact is that they're oversold or they overreact to the news that comes out. So I just thought that was a nice way to play it, but it's not something that I'm going to hold long term. It's just something short term that once everyone realizes that actually the whole banking system isn't going to collapse like 2007-8, then should just get a reconvergence to where it was before.
So do you hold any index funds? And is this something that you've ever considered doing?
I think I'd consider doing some index funds for my personal portfolio, just as a bit of a diversifier to what I'm doing with the fund. And I think, obviously that's what my clients have, is that they have lots of other investments and then the special situations. So yeah, I'd potentially consider doing some like index trackers myself, but I haven't done that so far.
Okay, well, that's all the questions. So if you've got anything else you'd like to add, then feel free to say it. But otherwise, thank you very much for coming on the show. Where can people go to find out more about you?
Yeah, thanks very much for having me, Sam. It's been a pleasure. So you can go and find me on Twitter. It's @JoeValue, and I'm open to, DMs are open. Feel free to message me with any questions. Looking forward to having a chat with whoever wants about any kind of investments. And also I've got a Substack, which is linked in the bio of the Twitter account. And that's Special Situations Global Equities, which is also the name of my fund. But there isn't actually much information out there on my fund. It's literally just that Substack where I put out some of my ideas that ongoingly and some of my thoughts. So yeah, feel free to have a look at that. And yeah, that's pretty much it.
Okay, well, thank you very much again for coming on the show, and thank you everyone for listening. I think that's everything in that case. So yeah, thank you everyone for listening, and we'll see you all next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.